Hi, welcome to another episode of Investing in the Real World. My name is Anthony, and this is where I share insights and information in the world of commercial real estate investing in hopes that you are inspired and that the information is helpful for you in your real estate investment goals. Today, we're actually going to be talking about value-add real estate. Value-add actually gets tossed around a lot, especially a marketing package to get some interest in a property. But today, we're going to be talking about what is value-add real estate, how to identify it, and how to do some basic math or calculations to determine what is the upside and if it makes sense for you and your portfolio. So be sure to subscribe if you haven't already, like, and let's get right into it. In a previous episode, I talked about turnkey properties, right? Turnkey would also be known as core real estate. Value add means that you're buying a property with more upside. So today I'm going to be talking specifically about multifamily real estate and value add. But value add real estate could be any type. It could be industrial, it could be retail, it could be office, and it could be, of course, multifamily. So what is value add real estate? When a property is core, it's stabilized, which means it has the rents really close to market rents. So it might be pumping out some good cash flow, but you're paying a higher premium for a property that's already running smoothly. A value have a few vacancies. It might have some tenants that need some turning over. There might be some units that aren't renovated at all. So the rents are a little bit low because maybe the units have not been renovated. Maybe the exterior needs a little bit of work. Maybe it's just some structure issues. Maybe it's the plumbing and the roof that needs a little bit of upgrading. But specifically when people are talking about value add real estate, they're talking about the value of the property. Where is it now and how much upside is there in the value of the property? So to refresh your memory, commercial real estate is valued primarily on the income. So when an appraiser is looking at a property, they're looking at a few different factors. So of course there's price per foot, there's the cap rate, there's the GRM or the GIM, and the price per unit. Okay, so there's four factors that an appraiser is looking at. But the one that has the biggest weight on the value of the property is the cap rate. So what they do is they take the net operating income of that property and divide it by the price, and that is the cap rate. So let me give you an example. You may have a 10-unit building, and you find this 10-unit building, and they don't really have much turnover. So the tenants have been there quite a long time, where the units aren't really renovated. The rents are probably not at market rents. And an investor looking at this property is saying, well, what kind of upside do I have in the property? Okay, so understanding that commercial real estate is valued on the income approach, the logical way is, well, if I get income up and or the expenses down, that means the net operating income is higher, therefore the property is worth more. Okay, so aside from the structural issues, structural would be foundation, roof, retrofit for the parking. There might be some energy efficient windows that are added to the property. There might be some better landscaping. Maybe it needs a new asphalt because it was broken up, so it needs kind of cleaned up there. So that's kind of the aesthetics. The income, which is really important, by the way. But of course, if you have a nicer property, you're going to be able to get more rents, right? So you get more rents, the property is worth more. But how do you tell if a property is value add when you look at the property and when you're looking at the books and records, or you're looking at what is called an offering memorandum, an OM, or a marketing package? What you have to be familiar with is you have to be familiar with what are the rents in the area. That's the primary thing you need to be looking at. There's a property that I identified as a value add deal. Now you could use this math formula for any property across the country, it doesn't matter. But specifically, I'm going to kind of walk you through this exercise of this 27-unit building in Los Angeles. So this 27-unit building, it consists of 1-bedrooms and 2-bedroom units. But for illustration purposes, we're going to say that all of them are 1-bedroom units, okay? So all of them are 1-bedroom units. Now in the marketing package, it's advertised that the average rent per unit is about $1,460, okay? So we're going to round it off. We're going to say that 27 units on average are collecting 27 units on average, I'm getting my calculator here, are collecting $1,500 a month, all right? So we're going to do that for really basic math. We know that the current rents are at $1,500. The market rents are at $2,100. So you know that the upside is about $600 per unit. So we take 600, times 27, because there's 27 units, and you get 16,200. Now you have to multiply that by 12 so we can annualize it. And then you get 194,400. Okay? Well, I know that most apartment buildings, most multifamily, have expenses that are between 30 to 40% of the income. So that means that the net income, if you get 194,000 in gross income, your net income will be about 60% of that. So let's get 194,400 times 0.6, and you end up with 116,640. So that's your extra net operating income in value that you created. Well, how much is that? If you get this increased value in income, how much is your property worth now, right? What is the new valuation? So 116,640 divided by 0.045, that's a 4.5 cap. The reason I don't use a 4 cap, even though I may have bought it at a 4 cap, is because you want to be conservative. You can't buy high and then also sell high, right? Divide by 0.045, that gives you an upside value of 2,592,000. Crazy, right? So to think of it, you created value of your apartment building that you purchased, the 27 unit. You got the rents from 1,500 to 2,100. Now, this is important when you know the upside in value, because then you could decide, well, does it make sense to make the purchase? So with this increase in value, you could decide, do I want to refinance and keep the property now that I created more value? Because when you go to the bank, they're going to appraise it based upon the net operating income. And now you've increased that, right? So you have more value. You could refinance, or you could flip the property. Maybe you're going to sell it and then repeat the process and find another value add deal. You see, some owners like to invest in turnkey properties, some like value add deals. Now you have a good way to understand if it's a value add deal and how much upside you have. Hope that was helpful. Be sure to subscribe, smash that like button. And if you want to get a hold of myself and my team, you could find us at investingintherealworld.com. Again, my name's Anthony. Take care and stay safe.